The COMEX silver price closed at $78.832 per ounce. That level sits more than 35% below its lifetime high of $121.755 per ounce. Both values exist together. In the present tense, no context. On Friday, January 30th, 2026, precious metals experienced one of the sharpest corrections seen in decades. Gold prices in the international market fell by more than 11%. COMEX silver prices fell by more than 31%. The fall followed an explosive rally to record highs earlier in the same month. The move was sudden. The scale was historic. The silver rate today remains 35% below its record high of $121.755 per ounce. The decline did not unfold gradually. It arrived after aggressive profit booking. The rally had already occurred. The reversal followed immediately. The sequence did not begin with metals themselves. It began with a nomination. President Trump nominated Kevin Warsh as the next chair of the United States Federal Reserve. Kevin Warsh is known for a hawkish stance on inflation control. He is also known for emphasizing Federal Reserve independence. That nomination triggered a rapid macro repricing. The United States dollar strengthened. Real yields moved higher. Leveraged positions in gold and silver began to unwind. Those positions were widely viewed as overextended debasement hedges. The unwinding was swift. It was violent. It erased billions in market value. Weak hands were flushed out. The process followed a classic transition from euphoria to exhaustion. This phase did not signal a structural bear market reversal. It reflected liquidation. It reflected repositioning. It reflected the removal of leverage. As the liquidation unfolded, institutions booked profits. That activity continued into the sharp correction seen on Friday. The silver rate today reflects the result. The fall did not occur in isolation. It coincided with changes imposed by an exchange. The Chicago Mercantile Exchange raised margin requirements. The CME had already raised margins for copper. Following that, it raised margin money requirements for gold and silver. Gold margins increased from 6% to 8% for a non-heightened risk profile. For a heightened risk profile, gold margins rose from 6.6% to 8.8%. Silver margins increased from 11% to 15% for a non-heightened risk profile. For a heightened risk profile, silver margins rose from 12.1% to 16.5%. Margins for platinum and palladium futures were also raised. The exchange described the move as part of a normal review of market volatility. The stated purpose was to ensure adequate collateral coverage. The change takes effect from Monday's close. Raising margins changes participation. Traders must post more collateral. Futures positions become more expensive to hold. The requirement applies regardless of direction. When prices soar, slide, or become extremely volatile, the exchange routinely raises margins. Friday's move followed that pattern. However, the timing matters. The increase in required collateral edges out smaller participants. Those without sufficient cash must reduce positions. Those reductions occur regardless of conviction. This process adds pressure. It operates mechanically. It does not respond to sentiment. As margins rise, forced selling can occur. Positions are closed to meet requirements. Volatility feeds into further liquidation. At the same time, demand conditions in India have shifted. According to Anuj Gupta, the Indian jewelry business has received a double hit. Prices for gold and silver surged. Demand remained sluggish. Market participants in India are now watching fiscal policy. There is an expectation of an import duty cut in the upcoming Union Budget 2026. The expectation exists to support the jewelry business. If such a cut occurs, domestic triggers would turn negative for gold and silver prices. Global triggers would also turn negative. The statement reflects current expectations, not future outcomes. The silver market now sits at a documented point. COMEX silver closed below $4,900 per ounce. That level carries significance within the framework described by market strategists. Amit Goel, chief global strategist at Pace 360, addressed the condition directly. He stated that the chances of the silver price rally topping out have increased. The assessment followed the COMEX close below $4,900 per ounce. The immediate focus shifts to the opening of the international market on Monday. The opening level matters. Failure to move above $4,900 during morning deals could intensify panic selling. That panic would not emerge from speculation. It would follow structure. It would follow positioning. Selling could accelerate after the opening of United States markets. This sequence has already been outlined. It is framed within current conditions. Despite structural demand remaining intact, silver prices are described as sitting on a bubble. The silver rate today remains above fair value. This assessment reflects current valuation, not projection. According to the same strategist, the sharp correction is expected to continue in the near term. The movement may not be one directional. Volatility remains embedded. Within this framework, a further correction of at least 30% from current levels is described. The price target mentioned reaches $50 per ounce by the end of June 2026. On the multi-commodity exchange, silver prices currently stand around 292,000 rupees per kilogram. In India, silver prices are described as potentially touching 200,000 rupees per kilogram by the end of June 2026. These figures exist alongside margin changes. They exist alongside liquidation. They exist alongside institutional profit booking. The CME Group confirmed the margin increases in a statement released on Friday. The move followed the biggest slides in decades across gold and silver futures. The increase means traders must deposit more collateral. The purpose is to ensure obligations can be met. The effect is immediate once implemented. As collateral requirements rise, leverage contracts. Participation narrows. Volatility does not disappear. The silver rate today reflects these conditions. It reflects a market adjusting to new constraints. It reflects the mechanical outcome of repricing, liquidation, and margin enforcement. No single factor stands alone. Nomination triggered repricing. Repricing strengthened the dollar. Rising yields pressured leveraged hedges. Liquidation followed. Margins rose. Participation thinned. The sequence is documented. The outcome is visible. Prices adjusted sharply. The present moment contains all of it. A 31% crash in COMEX silver. A 35% gap from record highs. Raised margins across precious metals. The process continues under existing rules. Markets respond to constraints. Exchanges enforce collateral. Nothing here requires interpretation. Nothing here requires forecast. The structure is already in motion. The current condition remains defined by documented figures. COMEX silver closed at $78.832 per ounce. The lifetime high remains $121.755 per ounce. The distance between them is not theoretical. It is measured. That gap exists after one of the most violent corrections in decades. Gold fell by more than 11% in a single session. Silver fell by more than 31%. Both moves occurred on Friday, January 30th, 2026. The correction followed an explosive rally earlier in the month. That rally pushed prices to record highs. Profit booking followed. The shift was immediate. Institutional positioning changed first. Leverage unwound next. Price followed last. The nomination of Kevin Warsh altered expectations at the highest policy level. His reputation for hawkish inflation control reshaped assumptions. Federal Reserve independence returned to focus. Markets repriced instantly. The United States dollar strengthened. Real yields rose. Assets positioned as debasement hedges lost support. Gold and silver were overextended. Leverage magnified exposure. When conditions shifted, liquidation became unavoidable. This liquidation erased billions in market value. Weak hands exited first. The phase matched a classic euphoria to exhaustion pattern. At no point was a structural bear market confirmed. The article documents a liquidation phase, not a reversal. As prices collapsed, institutional profit booking continued. The silver rate today reflects the net outcome. Simultaneously, exchange rules tightened. The Chicago Mercantile Exchange raised margin requirements. Gold margins increased from 6% to 8% for non-heightened risk profiles. Heightened risk profile margins rose from 6.6% to 8.8%. Silver margins increased from 11% to 15% for non-heightened risk profiles. Heightened risk profile margins moved from 12.1% to 16.5%. Platinum and palladium margins were also raised. The exchange described the action as a normal volatility review. The objective was adequate collateral coverage. The timing followed extreme price movement. The change takes effect from Monday's close. Margin increases alter market behavior immediately. Futures traders must post more cash. Positions become more expensive to hold. This mechanism does not discriminate by belief. It enforces compliance mechanically. When collateral requirements rise, forced position reduction follows. Smaller participants are affected first. Those without liquidity exit. This process amplifies selling pressure. It operates regardless of demand narratives. At the same time, domestic market conditions in India weakened. The jewelry sector faced elevated prices. Demand remained sluggish. The sector absorbed a double hit. Higher input costs, lower consumption, market expectations shifted toward fiscal relief. An import duty cut is anticipated in the Union Budget 2026. The expectation exists to revive jewelry demand. If such a cut occurs, domestic triggers would turn negative for gold and silver prices. Global triggers would align with that pressure. The silver market now trades below a critical level. COMEX silver closed below $4,900 per ounce. This level carries weight in current analysis. Opening behavior in the international market becomes relevant. Failure to reclaim $4,900 during morning trade could intensify panic selling. That selling could escalate after United States markets open. This is not framed as possibility. It is described as conditional structure. Despite structural demand remaining intact, valuation pressure persists. Silver prices are described as sitting on a bubble. The silver rate today remains above fair value. That assessment exists within the article. The correction is described as ongoing, not linear, not one-directional. A further correction of at least 30% from current levels is stated. A level of $50 per ounce by the end of June 2026 is cited. On the multi-commodity exchange, silver trades near 292,000 rupees per kilogram. In India, prices are described as potentially reaching 200,000 rupees per kilogram by the end of June 2026. These values exist alongside elevated margin requirements. They exist alongside reduced leverage. The CME Group confirmed margin hikes following the largest price slides in decades. The impact is structural. More collateral is required. Fewer participants can remain active. Volatility remains embedded. Liquidity contracts. The silver rate today reflects these forces simultaneously. Macroeconomic repricing, institutional liquidation, exchange-enforced constraints. No external context is required. The article documents the sequence completely. Markets adjust to rules. Prices respond to leverage removal. This is the present condition. The present condition continues to be defined by recorded data. The silver rate today remains 35% below its lifetime high. That distance exists after a single session collapse exceeding 31% on COMEX. The magnitude matters, the timing matters. The correction unfolded after an explosive rally earlier in the month. Prices had already reached record highs. Profit booking followed immediately. This was not gradual distribution. It was aggressive. The trigger was not internal to the metals market alone. It arrived through policy signaling. The nomination of Kevin Warsh as the next chair of the United States Federal Reserve altered expectations. His stance on inflation control is hawkish. His emphasis on Federal Reserve independence is well known. Markets repriced without delay. The United States dollar strengthened. Real yields moved higher. Assets positioned as debasement hedges lost support under these conditions. Gold and silver were among them. Leverage magnified the adjustment. Positions that had been extended during the rally unwound. The process was rapid. Liquidation erased billions in market value. Weak hands exited first. This transition followed a documented euphoria to exhaustion pattern. It did not signal a structural bear market reversal. The article is explicit on this distinction. As liquidation accelerated, institutional profit booking continued. The silver rate today reflects the cumulative result of these actions. At the same time, the Chicago Mercantile Exchange imposed higher margin requirements. The timing aligned with extreme volatility. Gold margin requirements increased from 6% to 8% for non-heightened risk profiles. For heightened risk profiles, gold margins rose from 6.6% to 8.8%. Silver margins increased from 11% to 15% for non-heightened risk profiles. For heightened risk profiles, silver margins moved from 12.1% to 16.5%. Margins on platinum and palladium futures were also raised. The exchange described the move as part of a normal review of market volatility. The stated purpose was adequate collateral coverage. The implementation takes effect from Monday's close. This change alters the mechanics of participation. Trading futures now requires more collateral. The requirement applies immediately once enforced. This mechanism is structural. It does not respond to sentiment. It enforces discipline through capital constraints. When margins rise, leverage contracts. Participants with insufficient liquidity are forced to reduce exposure. This process affects smaller players first. Those without enough cash exit positions. The effect is not discretionary, it is procedural. Volatility does not end when margins rise. Instead, the adjustment phase intensifies. As forced selling occurs to meet collateral requirements, pressure builds. The selling is mechanical. This is how margin systems operate. The article documents this outcome directly. Alongside these global developments, domestic conditions in India added further strain. The jewelry business faced elevated gold and silver prices. Demand remained sluggish. This created a double hit for the sector. Higher prices reduced consumption. Lower demand reduced turnover. Market expectations shifted toward fiscal intervention. An import duty cut is expected in the Union Budget 2026. The expectation exists to revive the jewelry business. The article notes this anticipation explicitly. If such a cut occurs, domestic triggers for gold and silver prices would turn negative. Global triggers would also align negatively. This framework exists within the current discussion. It reflects sentiment described by market participants. Returning to price levels, COMEX silver ended below $4,900 per ounce. This close increased concern regarding the sustainability of the rally. According to the chief global strategist at Pace 360, the probability of the rally topping out has risen. This assessment is linked directly to the close below that level. The next reference point is the international market opening on Monday. Opening behavior carries weight under current conditions. If silver fails to move above $4,900 during morning deals, panic selling may intensify. This intensification would likely occur after the opening of United States markets. This description outlines a conditional structure. It does not introduce new assumptions. Despite structural demand for silver remaining intact, valuation pressure dominates. The silver price today is described as sitting on a bubble. The silver rate today remains above fair value. This assessment exists within the article. The correction is described as ongoing. It is not expected to move in a single direction. Within this framework, a further correction of at least 30% from current levels is stated. A level of $50 per ounce by the end of June 2026 is cited. On the multi-commodity exchange, silver prices currently trade around 292,000 rupees per kilogram. In India, prices are described as potentially touching 200,000 rupees per kilogram by the end of June 2026. These figures are not isolated. They exist alongside raised margin requirements. They exist alongside institutional liquidation. The CME Group confirmed that margin increases followed the biggest price slides in decades. The increase means traders must commit more capital. The objective is to ensure obligations can be met. This change reduces participation among undercapitalized traders. It tightens market structure. The exchange routinely raises margins during periods of extreme movement. Friday's action followed that pattern. However, the context matters. The move occurred during a historic correction. As margins rise, liquidity narrows. Volatility remains present. This combination defines the current environment. The silver rate today reflects multiple simultaneous pressures. Macroeconomic repricing triggered by policy signaling. Institutional profit booking following record highs. Exchange-enforced leverage reduction. Each mechanism operates independently. Together, they produce the observed outcome. There is no single driver. There is a sequence. Nomination led to repricing. Repricing strengthened the dollar. Rising yields pressured hedges. Liquidation followed. Margins increased. Positions were reduced. Domestic demand weakened. Fiscal expectations emerged. The article documents each step. The present condition is the sum of these processes. The silver market now operates under higher collateral constraints. Participants adjust accordingly. The price does not exist in isolation. It exists within this structure. No additional context is required. No external inference is introduced. The events unfolded according to documented mechanisms. The consequences are embedded in the facts. Markets respond to rules. Exchanges enforce discipline. The silver rate today reflects that reality.